Hello friends, in the last 2 weeks, I've been talking to you about whether the markets will be able to shrug off the nervousness due to the Hindenburg report, and I've also given you empirical weight of evidence of the Copox oscillator. I've written about it in my Live Mint column as to how statistics can help us to gauge when the worst of fears of the markets ease. Now that has worked out exactly as we expected, and the markets are shrugging off the nervousness. But are there more pockets of nervousness emerging that can drag the markets down? And I'm going to talk about the new worries that could be possibly plaguing the markets in this video. So let's dive right in. And on your screen right now is the market roundup window, which tells you that banking stocks very clearly dragged the markets lower. It was the broader based Nifty which managed to notch gains. The US dollar index gained 30 basis points on a week-on-week basis, and that was a problem area for emerging markets, including India, and a strong dollar exerted downward pressure on commodity prices, as you can see. And what I take extreme amount of joy and pride is that energy, both crude and natural gas, have collapsed. And this is something what I have been stating and writing in great detail in a free Telegram channel, which you may please join. The contact coordinates are in the comment below, as well as in the description of this video. The USD INR also gained, which means the rupee weakened against the dollar. I'm going to talk about this in a bit in the bond market segment. The NSE lost a little in market capitalization, not really surprising considering the fact that banking was weak. The US indices registered some losses, barring the tech index, and that provided headwinds for domestic markets. Going to the MWPL, what we are seeing is that the risk appetite in terms of the utilization of exposure levels by traders compared to what SEBI allows is higher than what it was in the prior derivative cycle. So at 32.42, we are higher than what we were in Jan. So traders are definitely taking a greater risk appetite, but whether that will translate to more gains is something the coming trading week will tell us. The turnover of the indices and stock futures, remember these are cumulative three derivative cycles of February, March, April, rose up marginally. And it was no small measure caused by the huge spike in turnover on Friday, which was a down thrust day. A higher turnover in the banking stocks on falling prices is something that's a mild red flag. Now for the advanced decline ratio, what you are seeing is that the ratio has eased back below 1. That's not exactly very good news because we want the ratio to remain above 1, as high as possible above 1, with rising prices. That's not really happening. So this is the earliest indicator to tell us that risk appetite has shrunk a little. Now for the basis is nothing but the premium or discount that is prevalent in the futures versus cash. Basis has slumped. The Nifty basis is actually marginally above break-even point. Now, part of the reason, of course, is the impeding expiry of the derivative series, because the closer you get to expiry, the smaller is the premium on the futures. But it also indicates unwinding of long positions at higher levels. If basis inverts, that means if the futures were to trade at discount to cash, I would treat that as a sign of caution. Now, this is a metric that I update on my social media accounts every day. Do make it a point to connect with me and update yourself. Now for the impetus, our exclusive in-house indicator you won't find anywhere on the internet. The impetus rose marginally on the Nifty 50 and the Nifty has logged gains. But the impetus fell on the Bank Nifty and the Bank Nifty has lost. Now this divergence invariably leads to higher statistical beta or pure intraday price volatility. That's not exactly very good news for traders. I expect the volatility to spike up suddenly and the prices to start basically trading with big wide spreads in the bid and offer spreads. Now that will be a challenge. Now for the LWTD, another exclusive in-house indicator that you won't get anywhere else. This is a proprietary indicator. What you are seeing is that the Nifty gain loss line has risen a tad because the Nifty logged 0.49% gains on a week-on-week basis, whereas the LWTD remained above zero for the second consecutive weeks. Remember, last week I said this indicator has come above zero after staying in the negative territory for 5 weeks. The fact that it's staying above zero tells me that bulls are likely to offer some amount of buying support, although not in huge quantities because the LWTD reading is marginally above zero, but it's better than being in the negative. So watch this space. This is again something that I update on my social media every day. Friends, I now come to the bond market, which is the crux of this video, this particular week's video, because I'm going to cover another additional feature along with bonds. The fact that Indian 10-year benchmark bond yields, as you can see on your screen, have risen for the second consecutive week to 7.40%, which is the highest after 30th of Jan 2023. It's a 6-week high. That tells you bond prices have come down. Now that creates a mark-to-market loss for banks who are the biggest investors in bonds, and which is one reason why the bank Nifty has underperformed the Nifty 50 and as a matter of fact even fallen. It also tells you that bond markets are expecting interest rates to rise further from here. So that theory about interest rates having peaked is not something that I believe in. As a matter of fact, I've written great detailed posts on our free Telegram channel about why I think interest rates have not peaked and why just for you limited time offer only kind of deals, sweetheart deals that you're getting in fixed income instruments might just last. Now that's one reason why banking stocks are under pressure, because their cost of funds is likely to go up. Look at the way the largest bank in India, SBI, is raising interest rates or coupon rates on fixed deposits in double quick time. I haven't seen SBI raise interest rates in less than a month twice. Economic Times reported a small bank that has even started offering 9.5%. Now, these are banks scrambling for funds like there's no tomorrow, which means their cost of funding is going to go up. Now, cost of funding is a big issue with me as far as I'm concerned. Now, for the second issue. The second issue, what you're seeing on the screen is a weekly chart of the USD INR. For 4 weeks in a row, the rupee has declined against the dollar. Although LPA or long period average study suggests that the dollar since independence has logged an average gain of 3.5% to 5% against the rupee year after year. There are years in which we have seen exponential rise in the dollar versus the rupee. And if the USD INR was to break out above and sustain above the 83.35 or 83.40 levels and stay above it, I think the next leg of an upthrust in the USD INR could be beginning, and that would trigger both imported inflation and coupon rate hikes in India. On the downside, 81.5 is a level that I would watch very keenly because that is a moving average support. It's all very nicely explained on our free Telegram channel, so please refer to that. So these are the twin worries that I have about the market. Number one, a weak rupee triggering interest rate hikes, inflation, and interest rate hikes for cash carry trade considerations. And the bond market signaling that inflation could stay higher and the RBI MPC or the Monetary Policy Committee might just need to keep rates going higher. So I don't subscribe to the theory of interest rates having peaked out. Should you keep laddering? Yes. Do keep laddering, but don't write out the last check in your checkbook to fixed income instruments. Always, for now, leave a few leaves spare. And when it's time to go all in, I assure you, when I write out my last check, I will update the same on my Telegram account. So do connect with me there. It's absolutely free. Friends, I now come to the Bank Nifty, which bore the brunt of the decline. And as you can see on the daily chart on your screen, it fell on 3 out of 5 trading sessions. The price has closed below its swing high of 41,840, which is something that the Bank Nifty has not been able to break out above. I've been pointing that out to you for many weeks now. The price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. The average itself is pointing lower, so it's looking top heavy or looking sluggish. Take a look at the weekly chart here. We are now taking the support at the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook seems to suggest that mean reversion, where the price basically comes down to take support at the moving average and rise, or the price consolidates and the moving average rises up to test the price before the price makes a decisive move. Mean reversion is coming to an end. Now, whether the Bank Nifty is going to make a move upwards or is going to continue its journey down will be determined by the fact whether the price remains below or above the 25-week exponential moving average in the coming few trading weeks. Friends, in the week before last, the Bank Nifty was number 6 on our most volatile counters list as per statistical beta that we maintain in-house. It fell 2 notches to number 8, which is welcome because volatility came down. Now, lower volatility would mean that challenge for retail traders is lower. Last week, I advocated a range between 43,050 on the upside and 40,075 on the downside, which held perfectly well. In the coming week, I expect a range between 42,600 on the upside and 39,675 on the downside. I continue to advocate trading light because volatility is not yet done and dusted. Friends, I now come to the Nifty 50, which gained 0.49% and basically led the charge upwards. The broader based index rose on 3 out of 5 trading sessions, as you can see on the daily chart on your screen. However, the 18,115 swing high that it had made in September 2022 still remains a hurdle that the bulls are unable to cross over. The price is above its 20-day exponential moving average, which is a month-long holding on cost of an average bull, which tells you that this index has performed marginally better than the Bank Nifty. Do remember the Bank Nifty has an overhang of both bonds and the dollar index. The Nifty 50 is relatively, I'm talking relative, not absolute, relatively less impacted. Looking at the weekly chart, similar to the Bank Nifty, the price here has tested the 25-week exponential moving average, but at least closed higher. The candle is bullish. The Bank Nifty candle was bearish, but 18,115 remains a litmus test of the bull's intent. As far as I'm concerned, if the bulls are serious, hey, take the Nifty above the 18,115 level and keep it rising. In the week before last, this index was at number 20. It rose 1 notch to number 19. Now, that tells me that volatility went up a little, but at number 19, it's not a killer. Last week, I advocated a range between 18,350 on the upside and 17,375 on the downside, which held perfectly well. In the coming week, I expect a range between 18,425 on the upside and 17,475 on the downside. Do trade cautiously, trade light, keep your stop losses. Friends, what do I intend to do in the coming week is a segment that I've added in the video off late. I will continue to write options on interest rate sensitives. This is something that I have been writing to you on our free Telegram channel pretty often. I've been sharing my concerns, my game plan and strategies, both on energy and on interest rate sensitives. They remain the backbone of our trading blueprint because I'm betting on theta decay and to capitalize on ROI, which is return on investment, on the principle that we invest there. My call on energy prices coming down sharply have fructified, and especially on natural gas, which has been the backbone of our trades in the last few trading months. So we've basically exhausted our sell positions there, and we are sitting on the sidelines waiting for the next price move to start. As a matter of fact, I expect crude oil to be a little more active than natural gas where trading opportunities are concerned. And here again, I assure you, you'll be updated of these in our free Telegram channel. I would also start looking at some small positions, long positions in the USD INR on the NSE currency derivative segment in the March month futures. This is not a strategic or even a tactical buy call. This is more by way of a tail risk hedge, because I expect the move to be sudden if at all it does come. And at that point in time, hey, nobody minds a little bit of pocket change in terms of trading profits. So, like I said, it's not a tactical or a strategic trade. This is more of a tail risk hedge. Do your due diligence accordingly. Friends, I now come to the last bit of statistical studies in terms of retail risk appetite. On your screen now is the daily chart. The sky blue line tells me that stock options turnover fell marginally on a week-on-week basis as compared to the high of the previous weekend. Because stocks are more volatile than futures, it tells me that retail risk appetite was marginally lower. Stock futures turnover was in line with last week. Index futures turnover actually rose. And in the next chart, let's see the fall in the index options post expiry, weekly expiry of Thursday. The fall is less pronounced as compared to the fall of the week prior. That means the turnover in the index options on Friday was higher than the turnover of the prior Friday. Now, I have recorded a short video about what happens when traders move from futures to options and from stock futures and options to index futures options. Do check out that short video for greater explanation into why I say risk appetite has gone down, because traders are focusing more on indices rather than individual stocks. Friends, I now come to the most popular segment of this video for the statistically minded trader, where I give you 5 stocks that have gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. These are for scalpers. Do remember, this list is valid only for Monday. If you want to be updated of this list, Tuesday through Friday, it's updated only on our free Telegram channel. So do take the effort of joining in. The impetus gainers list is led by Tech Mahindra, followed by Torrent Power, ONGC at number 3, Reliance Industries number 4, and Bata at number 5. Impetus losers, where you take big exposure, wait for small price move, list is led by Divi's Lab, followed by Zydus Life, number 3 Hindustan Copper, number 4 Mahindra Finance, and number 5 FSL. Friends, before I bid goodbye to you in this video, please subscribe to my YouTube channel if you haven't already done so, and let me know in the comment section as to how my videos, both shorts and the regular videos, are helping you become better traders. Hey, this is your channel. These videos are for you. So I'd like to know whether you're happy with these. Help me reach out to a wider audience by sharing my videos with like-minded smart traders and investors like yourselves on your social media groups, on your WhatsApp groups, etc. Thank you for your patience and thanks for being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Bye-bye.